Good afternoon, everyone. Thank you for joining us here on this advisor seminar titled Manage Risk, Equities Exposure with Lower Volatility. My name is Vinny Wadera. I'm an Executive Director here at BetaShares, responsible for advice and servicing to institutional investors and financial advisors. I'm also joined by one of our partner firms, Wade Madison. Wade is the practice leader at Milliman. Wade, welcome along.
Thanks, Vinny. Pleasure to be here.
So Wade has been with Milliman for 16 years. He's also a fellow of the Institute of Actuaries Australia. Before we start, I'll just highlight that this seminar is for financial advisors only and is general information only and does not constitute personal financial advice. At the end of this presentation, we'll be sending you an email later today with a copy of this recording and a copy of the slides also. So let's now move to the topics here. I'll give a quick BetaShares update. I'll then ask Wade some questions relating to the topics of Milliman itself, risk management, portfolio construction, the actual risk management itself, and some strategy solutions. And then we'll throw it open to questions to all of you. In terms of the BetaShares update, look, we've continued to have very strong support and adoption of our ETFs. We have actually crossed 12 billion. This slide is a little dated already as at 30 June. We are now at 12.3 billion in terms of assets. In terms of market share, we continue to be ranked number 2 in terms of net inflows. This is net inflows for year of 2020. And what's interesting to note here is that the difference between the number 1 and the number 2 has contracted significantly, and there's quite a difference there between number 2 and 3. We really do put this down to a few things: our unique and differentiated strategy suite that spans across passive, factor, strategy-based, including these risk management strategies, and even actively managed funds where we partner with active managers. Also part of that is our client service and the support material that we provide, and we feel that we've put a lot of that support material to assist advisors, particularly in the last few months. And thirdly, we put it down to all of your efforts in terms of reviewing and selecting our strategies for your client portfolio. So thank you all very much. Let's now move to the topic here of managed risk investing. And it's a very interesting time that we find ourselves in, and in terms of market behaviour, how the market is behaving and how we think of the market also. And additionally, overlaying that with the significant benefit managed risk strategies can have with particular client types, particularly those that are more conservative investor profiles and those that are in retirement. So we at BetaShares here have partnered with one of the global leaders in this space. So Wade, could you please start on this section, just maybe share a little bit about Milliman, who you are, what you do, and who you do that for?
Sure, thanks Vinny. Yeah, so for those that may not have heard of Milliman, we're a global firm of actuaries, something like 55 countries now, 4,500 people, I think, at last count. And probably the interesting part is actually over 20 years ago, as we started working with our institutional clients, which were typically the likes of global insurance companies, pension funds, healthcare organisations. Our real background was in risk management, and where that started was working with those institutions in assessing risks and helping them manage risks are relating to their business on their balance sheet. So the real interesting kind of aspect of that is as we started working through the 2000s, insurance companies and others started to recognise they needed to manage risk with respect to their policyholders or investors, and particularly when it came to a number of the investment and product solutions that they had. So Milliman, being quite an entrepreneurial firm, we started helping our clients do that, and we did it with a view and an approach where we began actually managing risk, not just from the perspective of advising companies, which is where we started, but we actually started executing and implementing risk management philosophies and processes on their behalf. So the fascinating thing there is we effectively became this dedicated, risk manager or overlay manager. We don't particularly look at trying to generate, alpha and find value opportunities. There are many firms that are better at that than we are. But we've really built this unique expertise over many years, and now this history of operating through some of the most turbulent markets, whether that's the GFC or the more recent COVID crisis, managing risk for a number of institutional clients. Probably just over a decade ago, and this was really after the GFC, again, we expanded the areas that we operated in, because the sorts of things that we'd done for those institutional clients to help manage their balance sheet risks, where they were trying to ensure they had assets to meet the liabilities that they had created, we started to see that actually the exact same problem existed for advisors and their clients, because inevitably they have investors that are seeking to achieve a whole range of financial goals. And whilst it's nice to always think that markets will move upwards and it's all about return, there's just as much sophistication and challenge in making sure that we don't blow portfolios up. And it's a really challenging environment, and we saw that starkly through the financial crisis. So if you think about what we did for institutional clients, we looked at trying to find ways of managing risk that were cheap and cost effective, ultimately creating smoother investment journeys, and ultimately making it accessible. And so having done that for institutional clients, we found by working with groups like BetaShares, we're able to create really attractive, low-cost propositions that financial advisors and their clients could use to solve the same sorts of problems we've been solving for our institutional clients for over 20 years. And so, when we start thinking about that and start to describe what that actually means when we think about investment options and portfolios, what are clients seeking to achieve? They're obviously seeking to control the nature of volatility within their portfolios. So we can talk about this a bit more, but really what we're doing is we're trying to find a way of creating a more stable volatility profile. And as you would have seen, definitely through the recent crisis, is volatility is never this sort of stable thing. You go through periods where it can be very, very high, and you see, in this case, the fastest correction I think we've seen on record, also followed by the fastest rebound. But we also need to, not just manage volatility, but focus on protecting investors from downside risk. And we'll see this as we kind of work through some of the actual performance of some of the strategies that we run. But ultimately, we think that creates a huge number of benefits for advisors and what they're attempting to achieve for their clients. Also creates a whole bunch of opportunities and benefits for clients, because as we've seen, we are all human and we suffer from this thing called loss aversion. And in the depths of the COVID crisis, the tendency or the focus on potentially selling out because we don't know how bad this correction will get becomes very, very significant. Now, fortunately, markets have rebounded, but as we know, and as we've seen now, the uncertainty going forwards is immense. We're not sure where markets will go from here, and still has an impact on investors to make them quite nervous.
Let's circle back on that in a moment, Wade, but look, thank you for that overview and introduction of Milliman and what you do and who you do it for. Look, another way, and certainly we highlight this as really the democratization of investing. The investment strategies, the risk management strategies that were previously only the domain of large pension funds and large insurance companies are now available in an ETF format to all investors can access that. So we think that's quite a powerful investment evolution here. Let's now move to managed risk and portfolio construction, please, Wade. And could you just share with our advisor clients why is it important to consider or incorporate risk management within investment portfolios, and particularly if you could focus on retirement? And then secondly, what's some of the work and research Milliman have done in this space?
Yeah, sure. Thanks, Vinny. So look, obviously, Milliman as a consulting firm, and we've been operating in the Australian market since 2005. So we've been here for quite some time. We've built up quite a deep set of resources around research that we've done and information that's freely available to advisors that would be interested in digging into some of these topics in more detail. So I think this slide sort of highlights that, and feel free to go and trawl through this information and take a closer look at some of the more detailed analysis that we've done. But really, if I was to try and sum it up, as I said at the outset, risk management isn't necessarily about providing all of the upside and none of the downside. As investors and advisors, we know that that is an impossible dream. Ultimately, we operate in a world of trade-offs. So there is a cost to protecting downside. But what we've done as a focus on an institutional client base is we've tried to find ways to manage the downside that are the most cost-effective and resilient under significant stress. And I think this is the real area where, as a business, we're very, very proud of what we've achieved, because through both the GFC and the COVID crisis, the strategies that we've run for advisors and their clients have held up remarkably well. And you'll see that as we kind of work our way through some of the actual performance numbers. I always like to think about, and I said this at the very start, is if you're looking for alpha generation, then obviously, that's not where Milliman sits in portfolios. So we like to, think of ourselves as a sort of Iceman, a very methodical, meticulous, risk manager who works very, very well in conjunction, with those investment superstars, those mavericks, who are able to identify value and place the right bets at the right time, which, as we know, is still a very challenging task to be able to do well. And as we're working through investor questions, why we focus on risk so much, and I think, again, it's very much the way we approach things, is that everything an investor is attempting to achieve, there's a question about, well, what if? So if we think about superannuation or a financial goal, do we have enough? And can I get enough and get what I need with interest rates at historical lows? And we're seeing now that inevitably the answer to that question in many cases is no. So people are forced to invest in asset classes to get extra return. And as we know, extra returns come with risk. There are other areas, whether it's investor behaviour, can I follow the plan that we've laid out? We know loss aversion has a massive impact on that. What about things beyond our control, whether that's markets, inflation, interest rates, or longevity? So, we think this whole investor problem is a really big conversation around risk, how we manage it effectively. And as I said, it's about, combining those sorts of skill sets, and putting them alongside people that can seek additional returns and alpha. And just to sort of think, and I guess this is really fascinating from our perspective, having operated in the Australian market now for so long, even our thought process and our experience working with advisors in how they choose to use risk management within their client conversations and the portfolios they put together for investors is immensely varied. So advisors, will do a whole range of different things depending upon their personal views, the nature of the client they're facing. And so one of the things we've been very cognizant of doing is not to try and say that any of these strategies can be shoehorned into one specific approach. It's about giving advisors and their clients another tool that they can deploy as they see fit. And so a couple of examples, specifically, if we think about it from a tactical perspective. So as I said, we've had advisors that we've spoken to that have now got clients that have been in cash, they've had it sitting on the sidelines, and given where rates are at, they're looking for opportunities to reinvest to get additional returns, but they don't want to do that without having some element of risk management in the portfolio. So we think that's one good example. Advisors using core satellite approaches. So the interesting thing there is is as you're developing portfolios and you want to have a core component of the portfolio and have satellites that are seeking and chasing alpha and growth opportunities, then you have this innate conflict between the fees you pay for these satellites where they are doing a lot of value add and the core of the portfolio. So by having a risk managed core, for instance, that is cost effective, it actually frees up fee budget and gives you the ability to actually allocate more money to punchier satellites. And then the final one on the bottom left-hand corner is there clearly, given the nature of superannuation environment, there are just groups of people, and particularly for people that are close to or in retirement, where managing risk and having the dual, objective of higher returns because they're going to be retired a long time, they need to keep pace with inflation, but also making sure that they don't lose money when they've probably got the most money they've ever had in their lives is important.
Great, Wade. No, thanks. And look, if you could just maybe did you want to touch a little bit more on the retirement and the core satellite, or shall we move to the next section?
Look, I think we can move on. There's plenty of, as I said, there's plenty of research, and we tend to find advisors have seen this over and over again. So, retirement's a really good example because, I think in a lot of markets what we've seen is as people get closer to retirement, there are popular strategies where they get de-risked, right? And so you say, well, we're going to, make them less exposed to growth because they've got the maximum amount of money they've ever had. The challenge with doing that now is by putting people into low risk assets, the returns are effectively close to zero. So what you ultimately do is you guarantee that they will run out of money because we're retired for 30 years. So the challenge is, how do I maintain aspects of growth but make sure risk is managed effectively? And there's a wealth of statistics and articles that will delve into that. And maybe not the core satellite approach, Vinny, is worth delving into, but this idea of buckets.
Yeah.
Because I think what we have found is a very, very popular concept, right? So particularly within the Australian market, where advisors will take clients and they will actually set their portfolios up using buckets, a bucket for money that they're going to use in the short term now, stuff they're going to use in the next couple of years, and stuff they'll use later. And generally it's a very good approach because, again, we talk about behavioural principles. There's this innate behavioural dynamic, which is referred to as mental accounting. So as humans, we have to chunk things up. We can't think of multiple concepts in this one, big mess, right? So by breaking portfolios up into these time-weighted buckets, it gives a very clear purpose as to what that money is allocated for. Now, in a lot of scenarios, those buckets will be helpful, particularly in a correction where we've seen just the speed that it's declined and then rebounded. But the interesting thing, and why we still think buckets can leverage the power of a managed risk investment strategy, is that they don't always work. Sometimes those corrections occur and the rebound's nowhere near as fast as what we've seen most recently. So it's really, really interesting. In the depths of the COVID crisis, as we were talking to advisors and they were interested in how they could manage risk more effectively, they were sort of faced with this puzzle because the clients had been advised, they'd seen the correction, it had hit portfolios, and you're sort of in this position of going, well, I've just got to ride this out to some extent. And so the interesting thing for us now, given how markets have recovered, is we're actually seeing much more interest in how you take these sorts of strategies because there aren't many clients out there that we've spoken to or heard from that are sitting there saying, well, I think that's all that's going to happen and markets are just going to go gangbusters from here. There's a lot of uncertainty, a lot of concern that maybe there's another fall to come. And so in some cases, we've dodged a bullet. Now may be a really perfect time to think about how you deploy risk management strategies within something like a bucket strategy.
Yeah. And certainly, Wade, we can, the BetaShares account management team can reach out and assist with that also in terms of really exploring what your current portfolio construction approach is and then suggesting some solutions. But I'll come back to that in a moment. Wade, let's now move on from sort of the conceptual and the overviews to actually getting into what is this risk management strategy? What's the nature of markets it seeks to address, and what are the components? And then separately, we'll go to the results then. So yeah, if you go to the strategy overview and how does it work?
Yeah, so let me maybe just first give a little bit of background as to really philosophically how a risk manager thinks about investing and risk management, which will be somewhat different to the way a typical alpha-based manager will approach things, right? So, if we're managing risk, the fundamental bedrock upon which we have to deliver an outcome is that we need to deliver an outcome that has an element of predictability to it. Because if we're managing risk in a way that people don't understand and don't know what the portfolio will deliver, then we've failed our job, right? Because ultimately you sit there at the end when the event has happened and you look at the COVID crisis as a good example and you go, the portfolio didn't deliver. And that's the message we have to kind of give to clients. We have to give them confidence and surety that the portfolio will do what it was supposed to do. And so because of that, where we start is we run a rules-based approach. And by using a collection of rules into how we manage risk, we can effectively say, given any particular scenario, here's what you will expect. And we've seen by doing this through the financial crisis, which was a slow, drawn-out correction, and now we've got experience through COVID, which was a very sharp correction and rebound. The strategy, as we've implemented, did exactly what it should have done. And a useful thing for that, when you're talking to advisors and clients, is you can give them a whole wealth of statistics. You can give them tools that allow them to illustrate to clients how these investments will perform in different scenarios and provide that comfort. And that's really kind of around working with advisors, and I know we've done a lot of work with BetaShares on this to highlight and demonstrate how these strategies will perform in different markets and how you can tailor it and fit it within an advisor's approach to asset allocation. Now, having said that, just the final point on that prior slide is vitally important, because we see a lot of organisations and approaches to risk management, but there's a very big distinction between an organisation, for instance, that has a couple of traders in an office somewhere managing risk, compared to a global institution like Milliman, who's been doing this for 20 years. And the reason, and it's often, if we do our job well, you actually never see this, because when people expect us to deliver the result, right, it's infrequent. So big events like COVID or the GFC might happen once every 7 years, once every 10 years. And so when it happens, markets are under the most stress they've ever been under. The activity levels are massive. The positions and the changes going on are very, very high. Any chink in the processes and the systems you have built to manage risk will get exposed. And so what we pride ourselves on is we're operating a global trading operation that has been tried and tested many times, and it's come through in flying colours. So an investor and their clients will never ever notice this, because we simply, continue running operations in a robust way. But unfortunately, there have been, examples where firms' operational processes get exposed in these sorts of markets because there's such extreme changes.
Okay, Wade, the secret sauce.
Yeah, so really two relatively simple strategies, but as I said, execution is always the most important thing. The first thing we do is we monitor volatility in markets, and we're attempting to manage, or we manage the investment, the risk, to keep volatility at a relatively stable level. So what the chart on the bottom left-hand corner here shows you is that volatility within markets over very short time horizons can be much, much higher than what we've baked in to our asset allocation models. And normally what happens most of the time, that high volatility is associated with a market correction. So you can see here, we've got the Russian financial crisis, we've got 9/11, we've got GFC, Eurozone in difficulties. Unfortunately, COVID's not in there, but if you see COVID, you get the same pattern. And so because we see these spikes in volatility, what we do is we're able to use that as a way of ensuring that that is a signal that markets are likely to have a correction, and we will manage the portfolio and the strategy to put protection in place. The second part is then once you've got that, volatility management within the portfolio, is you now then need to run the protection strategy, the downside protection strategy. And the simple way of describing what we do here is we're effectively creating an option-like payoff without trading options. So again, our systems are built in such a way that we're trading and looking at markets in very frequent intervals, and we're trading futures. And we use futures because they're very cheap and they are incredibly liquid. So even when markets are under the most stress, particularly in these sorts of scenarios, you can get in and out of futures relatively easily. And I think the real benefit, and we're seeing this right now, where markets have rebounded, we know options are expensive because you have to pay a whole bunch of people, including investment banks. The amount of protection you could have gotten from an option before the COVID crisis was much, much greater than what you can get now. So firms that are using options in their protection strategies are paying a lot more just for the same amount of protection that they got before COVID happened. Yeah. Whereas we're delivering protection at relatively similar costs to where we started.
Thanks, Wade. And look, this is really at a higher level what the components of the risk management strategy are. We at BetaShares have collated some summary documents on this. We've also collated some analogies that you can share with clients too. They're on our website in terms of a sailboat and sailing in different environments and weather conditions. And certainly we can follow up with a meeting with you. Wade's available also to run through any level of detail that you'd like on this risk management strategy. Wade, might be worthwhile just moving on to just some historical analysis and key features before we move on to the results then. Or shall we just move on to the...
Yeah,
I think one important topic that I'd really like to touch on is this, and it's really taken from a paper that Milliman collated a few years ago now, is this concept of diversification and even the notion of the failings of diversification. Certainly in recent times, from the advisors that I work with around the country, many are even exploring things like hedge funds, CTA strategies, long short strategies, with the view or the promise of diversification. So really keen to hear your views on that.
Yeah, thanks, Vinny. And it's quite fascinating again, because exactly the same conversations took place after the GFC. So the natural response when we have an event, like we've just had, is that, well, we'll need to diversify our portfolios further. But that comes with a whole bunch of challenges, because as you start diversifying beyond what you're familiar with and what you're comfortable with, is you start introducing asset classes and approaches that become quite exotic. And the nature of that, whether that's sort of macro hedge funds or long short or whatever it might be, is firstly, because they are more exotic strategies, they're less common, you pay more. Right? So fees go up. The second thing is, because they are the way they are, we actually don't know how they'll behave or how they'll perform. So we're kind of hoping that they will do something in a crisis event. The other potential issue is, if you're looking at an event like COVID or the GFC, then actually the nature of that event is so significant, every other asset class goes down anyway. So even if I allocate 5% of my portfolio to alternatives, I have to leverage that up so much to get the protection benefits across the entire portfolio. So you kind of face this, space of diminishing returns. And unfortunately for hedge funds in particular, over the last couple of major market crises, they haven't necessarily had great results either. So, people have been disenfranchised in some respects because they were there to, provide insulation in these sorts of corrections, and they just didn't deliver. So the way we think about it is rather than take that bottom tier, which is this asset allocation tier, and make it much wider and broader and complex, is think of it much more in this pyramid style, where what we're focused on is adding this risk control layer into the top there. And that's why when we talk about our business, we talk about ourselves being an overlay manager, because we're able to deploy overlays against the growth assets within people's portfolios, which means you're actually running protection and risk management against the bulk of the money. So you will see in the performance that kicks in. Then obviously options do have a place because they can provide additional protection in certain markets, particularly where you get market gaps, but they can be expensive. So you kind of work through the pyramid because what you're doing is you're saying, well, what's the next low-cost vehicle I can use? And so we tend to structure this up in the way from sort of cheapest to most expensive. At the very top, you've got what I refer to as kind of catastrophe protection, which is ultimately you can go and buy a guarantee from someone. The only issue you've got to be cognizant of there is hopefully when the crisis event happens, the firm that gave you the guarantee, is still around to make good on it. So, in the GFC, if all your guarantees were purchased from Lehman's, there were a few challenges there. Or you can kind of get a guarantee by putting all your money into cash. But the challenge with that obviously is, zero return for zero risk.
Fantastic. And if anyone requires, we can actually send you this paper that was collated by Milliman. But again, I just wanted to highlight here, just those, as Wade mentioned, broadening your strategy selection here, you may just be taking on more risk and strategies that actually have proven very rarely to deliver in drawdown events. Let's now move to the BetaShares solutions here, the strategy solutions. And there are really two I'd like to highlight to you. The first one is the BetaShares Managed Risk Australian Share Fund. This is an underlying holding of the top 200 Australian shares by market cap. So it's index passive Aussie equities with the Milliman risk management strategy. The other one that I wanted to highlight to you is a global strategy. We'll come to that in a moment, but it's just interesting to show you the results here. The long-term results of an Aussie equity index with the risk management strategy. You can see the line here, it's the orange line. There are periods where it underperforms, there are periods where it overperforms. Over the long term, you can see on a risk-adjusted basis, it is quite favourable here. And the risk-adjusted is the measure of this volatility or the variability of returns. It's a lot smoother ride here with the managed risk strategy. So this is all wrapped up in the ETF, which is the ticker code AUST or AUST. I want to just touch on, Wade, the drawdown analysis. This is very interesting because we see historically here, and this is where that lower variability or volatility of returns comes from. You can actually see here in periods of drawdown, particularly the financial crisis and even other periods since then, including the recent time, the drawdowns are just much lower here for AUS or the managed risk version, which means your time to recover are shorter. Let's just blow out the recent COVID period, so year to date here, which is the previous slide. Now, this is very interesting. This is the time when many active managers, many uncorrelated strategies promised to deliver, but very, very few did. Let's just have a look at these results here. Wade, do you want to comment on these? What's happened, the hedging level and the results?
Yeah, sure. So obviously you've got the two lines which show you the relative performance of the market versus the risk managed investment or the market with the risk management strategy. And then the solid bar, which is underneath, is effectively highlighting to you the extent to which we're hedging against further market falls. So the first comment is, and maybe a bit, Vinny, I'll just kind of mention, I think, one of the things that I think is somewhat challenging, and we tend to try and steer clear of this, is this whole conversation around over and under performance. Because ultimately what you compare on the earlier slide and this slide is you're seeing a market where there is no risk management strategy. It does what it does. And so when we talk about comparing a strategy that has risk management in place, I'll tell you now, it will always underperform in a rising market because I cannot get all the upside and limit the downside. So it's a basic expectation that when you're positioning clients here, you're going to have that conversation with them. But what it means is this is not outperformance. This is the benefit that you get by sacrificing some of that upside. In a crisis like this, the risk management kicks in, and I guess our fundamental belief is by having this strategy in place, it's attuned to the loss aversion that investors feel. And if you superimpose on this investors that decide to get out at the bottom and then miss rebounds and how that behaviour impacts overall portfolios, the actual benefit's much, much greater than what you even see in this chart. So what you're seeing is, and again, this is rules-based, so we know that as the performance plays out, this is exactly what we expected to happen, because what we're attempting to do is we're still attempting to maintain growth and upside as much as possible. And so what you can see through January, February, March is markets were still kind of trending upwards. And so you can actually see the risk management strategies doing its best to keep hedging levels relatively low, to keep us exposed to market growth. But as markets started to correct, we're actually following markets pretty solidly, because we're still waiting. You know, for us, we're much more focused on large market corrections, not small ones. And so as markets fall a little bit, we're still thinking, well, they may rebound, and we want to be positioned for that rebound. But as it starts getting away, what you can see is the hedging level ramps up, but it ramps up very, very quickly. So between March and April, you can actually see significant change in the amount of protection and hedging that we've put in place. And it comes through straight away in the actual performance. And so our performance always stays, you know, kicks in, we flatline out while markets are still correcting. And then fortunately, markets have rebounded back. They're still underneath where the risk management strategy is. And what you can see here is more recently, our hedging levels have started to unwind to some extent. So we're starting to get a bit more position for markets that may swing back, but we've still got a lot more protection in place than we did at the very start of the crisis.
Fantastic. And look, that similar concept also applies to the global fund. So this is the Managed Risk Global Share Fund. The ticker code for this is WRLD. And again, similarly, you can see over the longer term, and I'll be careful to say over or underperformance, but look, the results are, it is, you know, generally on par in terms of annualized return. The volatility is much lower, which means a favorable risk-adjusted return. Again, we can see in the drawdown events historically, sort of the bear markets of the 2002 and onwards, and then the financial crisis, the drawdowns have been a lot more shallower here in the managed risk strategy versus the equivalent global index. Again, as per the Aussie fund, you can see that variability of returns has been a lot lower in WRLD than the broader market there too, in terms of the recent this year's results too. We might pause there, Wade, and just take some questions. There's a lot of questions here. I might just, in the interest of time, take 3 or 4. I promise that we will reply back to all of the questions. So I'll take one here from Anthony in Perth. Thank you for joining us from Perth. So where do these funds, the Austin World, fit in my portfolio? And to that, I think I might go back to the slide where Wade mentioned the applications. So Wade, really it comes down to the core satellite and the type of clients also. So going back to this slide here, really it's the bottom two, the specific goals in portfolio construction.
Yeah, look, you know, so if I even start in the first top column, I think, firstly, you know, we think all investors, well, we don't think, we know from studies that all investors suffer loss aversion. And effectively what that means is they feel much more pain from losses than they do satisfaction from gains of the same amount. And we see this time and again where if risk profiles we tend to use don't take this into consideration, then inevitably when you get a major correction, you have a whole bunch of clients that start ringing advisors up going, what's going on? And the answer, and we all know, isn't to say, well, we risk profiled you, you're in the right investment for your risk profile, right? So loss aversion manifests itself in these events. So we think everyone can benefit to some extent from having risk management in their portfolios. Retirees are much more exposed than other people. And actually part of the reason retirees and people close to retirement is actually when you look at the studies on loss aversion, the loss aversion at those older ages is much, much greater than loss aversion for people that are younger. And one of the reasons is because they've now got the most money they've ever seen in their lives. So it's actually more exposed and they don't have the tools to go back to work, to earn more income, to replace losses. So we think for that very reason, retirees are very strong candidates for these sorts of approaches. But then in the other areas, we've seen advisors, and it's been, again, a real learning exercise for us, and one of the reasons that we enjoy collaborating with advisors so closely because they always come up with ways that we hadn't necessarily thought of how you might want to use this. So as I said, advisors with clients that have money on the sidelines that have been waiting for opportunities to get back in, but they still have a lot of uncertainty. And so, replacing cash-like returns now with something that has more equity dynamic to it, but has protection in place. We're seeing that come through from a tactical perspective. And we're also seeing advisors now and their clients think about rejigging portfolios in that core satellite context.
Sure.
How do I kind of keep fees down, but actually now seek more growth opportunities, but do it in a more tactical way by focusing on specific sectors or thematics.
Exactly. So Anthony, we trust that assist, but if I had to summarise where does it fit, it certainly fits as your core allocations for Aussie equities and global equities, and certainly would be a very good candidate for retirement portfolios. So another question here from Sanjay in Balcombe Hills. How can I tell the current hedge of the funds? I'll just see if I've got it on the front page here. No, I don't think I do. But the key would be, it's actually listed on our website. I don't have it here, but under the resources tab of our website for both AUST, AUST and WRLD World, just scroll down to portfolio characteristics. And off the top of my head, well, when I looked at it yesterday, I think WRLD was hedged around 32%. And the Aussie fund AUST was just shy of 50%, so around 47, 48%.
I think it's, correct me if I'm wrong, Vinny, I think it's actually updated on a daily basis.
Yes, it sure is.
So
yes.
It's quite fascinating, again, when you think about the amount of transparency that is available to advisors now, where you've got a very dynamic strategy like this that as you've seen through the COVID crisis, hedging levels were changing very frequently. And actually, interestingly, we've got a number of advisors that have been using us for a whole range of purposes, and using us in different ways. And fascinatingly, on unit trusts, for instance, because of the way unit pricing was working, they couldn't find out where hedging levels were at. So we're actually getting direct requests to, as markets were moving so quickly, how do they have these conversations with advisors? So I think it's just another illustration of the transparency and benefit you get from listed vehicles like this.
Another question here, James from Ballarat. Interesting question. Can I dynamically tilt between AUST and the index fund? Look, our well, not just recommendation. We would say these are not meant to be trading products. These are meant to be, Austin World are meant to be the strategic allocations, long-term allocations for your equities exposures. Anything else you wanted to add on that, Wade?
No, look, mate, I think that's right. I think we've definitely seen, and the challenge is in a correction like we've just seen, people that made the choice to turn off all risk management at the bottom of the market were either in the know and knew something that most of us didn't know, or were incredibly brave. So I think, generally, we don't tend to see this from an advisor perspective where they, will want to be in and out and it just causes operational challenges. I think a much more intelligent way is that real core satellite approach where, at the depths of the crisis, then advisors may have thought, or their clients may have had a view that there were real value opportunities in certain aspects of where markets were and particular sectors of the market. And manage risk as a core gave them the ability to hive some money out and put into those types of satellite strategies.
And look, the only other thing I'll add there, Wade, is that the hedge is dynamic, so it's being undertaken within these funds. To tilt out of the fund or to actually exit the fund altogether, you're actually applying your second guessing what the markets will do in the hope that you'll get that right. And again, the strategy here, as Wade has mentioned, is got a long track record. It is targeting a particular nature of markets, and it's predictable too, given the rules-based nature. I think we'll have to leave it there. There's still a whole lot of questions here, which we will come back to everyone individually. We'll promise to do that. We'll send a copy of the presentation. We'd really appreciate your feedback on this in the survey that pops up, particularly if you'd like us to follow up with you. In any event, we'll send you an email, or your BetaShares account manager will follow up with you. We're very proud of these strategies. We believe they have some very strong applicability to certain client and investor types. So we'll follow up with you shortly. Look, thank you all for joining us here. We at BetaShares have provided a lot of support and material, and this webinar forms part of that. We'd be very happy to undertake any sort of analytics or further information. I'm sure Wade will be very happy to join us on some follow-up conference calls with you if you require. Look, we really do wish you all the best, and your team and your loved ones during these very challenging times. Thank you very much. Thank you, Wade.
Thank you.